Hi there. Life isn't that great for Intel and its shareholders, because as you can see, the performance of the stock price wasn't that great in the last 2 years. The investors have had a decline over 46%. Of course, they also got some dividends, a small dividend which has been reduced. As you can see, the dividend has been reduced from $1, $1.50 to 70 cents, and so on. It's expected to increase even more in the future. And this is bad for shareholders because, as you can see, the stock price was about $68 in 2021. But back then, Intel was making, as you can see in this image, about 74 million in revenue and almost 20 billion in net income earnings. But now, because the business has shifted towards higher investments, you can see that their net income has decreased to 1.6 billion. So you see a big decline from almost 20 billion to 1.6 billion. And that's why the dividend has been reduced and also the stock price has declined so much. From its highest peak to the bottom, a decline of 61%. Of course, the stock price has rebounded because, as you can see in these estimates, those are the analyst estimates, the market expects a rebound in their earnings. As you probably know from news and their presentation, Intel is investing in their infrastructure. They want to open new factories around the world, as you can see. Wafer fabs, assembly and test, advanced packaging, and future sites around the world in the US, Europe, and other countries. And of course, they also have some facilities in Asia. So, as there was this shortage of chip shortage, and problems between the US and China, there are more tensions, trade war, there is a high need for chips that are developed in their own country, in the US, and also in Europe, so that the Western world doesn't depend so much on China. They want to diversify. In case other problems arise, they are protected. They have their own manufacturing capabilities. And that's why they invested so much in those facilities. And you see this massive decline in their earnings. They took their profits, their free cash flow, to invest in their infrastructure, in facilities, hoping that in the future they will earn more money. And this is the problem. I mean, the market knows that manufacturing is not that a great business. The future returns are likely to be low. But as you can see, analysts expect a rebound in their earnings, back to almost 20 billion. Not really, but to 18.6 billion, if you want to be more precise. This is what the market expects. So, if you read more about Intel, their presentation, their latest report, you can see that the guidance for the first quarter of 2024 is that the revenue to be about 12 billion, and their earnings, they are expected to report a loss of 25 cents. And this is bad. You can also look at their segments. As you probably know, they have Client Computing Group, Data Center, Network and Edge, Mobileye, which was spun off, and Intel Foundry Services. This segment is expected to grow more in the future as they are building their infrastructure around the world. So, I think you already know what they're doing. Client computing is more about chips related to laptops and other computers. Data center for cloud computing. Network and edge is related to telecommunication companies. They sell chips to telecommunication companies. And of course, other companies that work in that industry. Mobileye is for automotive, and Intel Foundry Services is about producing these manufacturing capabilities around the world. So as you can see, in the last quarter, Q4 2023, the revenue was up for client computing. And of course, this segment represents a huge portion of their total revenue. As you can see, 8.8 billion in the fourth quarter. And data center, which is related to cloud computing, was down 10%. And year over year was down 20%. So this is a huge decline. The network and edge was down 24% in the last quarter. And year over year, down 31%. So this is quite bad. And also, if you look at the client computing group, the revenue was also down 8%. So as you can see, this business is doing quite badly. You can easily see that the revenue has declined from 2020. Let's look at 2020 because in 2021, 2022 was that pandemic. People were at home and they were playing more video games. So they bought more laptops and other devices. But let's compare with 2020. Compare 2020 with 2023. You can easily see a decline in their revenue from 77 billion to 54 billion, and also their profits. Now, as I said, they took their profits to invest in their infrastructure to make more money in the future. And that's good. Maybe they will succeed to earn a nice return on those investments, if they can. But let's forget about their earnings. They might rebound in the future, as the market expects. Focus on the revenue and ask yourself why the revenue has declined so much, from almost 78 billion to 54 billion. This is a question mark you have to ask, especially if you want to invest in this company right now. Because if you read more about the industry they operate in, especially this industry, data center and network, you can see that more cloud providers are developing their own chips. For instance, Microsoft, Google, Amazon are developing their own chips for their own data centers so that they can improve their performance even more than what Intel and other chip companies offer. This is a bad sign for Intel. Even though they succeed with their foundry services, they might succeed to earn a nice return on their investments. You have to ask the question about their segments: data centers, network, and cloud computing. If those segments can rebound in the future. If they can, then the revenue might grow more than 85 billion in the future, and so their earnings. So my take on Intel is that their earnings will rebound. I don't know if they will succeed to make over 10 billion in earnings in the next 5 to 10 years. Maybe they can. But you also have to be aware of their decline in their revenue. The market expects a huge rebound as they invest in this huge infrastructure to expand their manufacturing capabilities. But as I said, you have to ask yourself what return will Intel earn on their investments. Because as you've seen, they are investing billions of dollars every year, around 20 billion of dollars. And if Intel isn't able to earn a nice return on that investment, then your future returns, on this investment, won't be that great. And you can easily compare their market cap, which now is about 150 billion, with the current earnings, which are around 1.6 billion. If you look at the past, let's say in 2020, when they were able to make 20 billion earnings, the market cap was about, let's look at the chart, was about 280 billion. So if Intel can make again 20 billion earnings, then a market cap can go from 150 billion to 280 billion. If this company keeps growing, they report a higher growth rate in the future, and the market expects that their earnings will increase more in the future, as they were expecting in 2020. So if Intel succeeds to turn this business around to make more than 20 billion earnings, then the stock price can double from the current level. But that's it. You can't expect a higher return than this. Of course, a double in the next 5 to 10 years, because as you can see, their earnings are expected to rebound in the next 4 years. or 5 to 10. It depends also on their investments, what return they have, and future problems that may arise. Now, you can try to calculate their fair value based on those estimates, their earnings, the future earnings of Intel. And you can see that if you want to start first with the risk, you can see that the stock price isn't that undervalued. You can see that the fair value per share may be around $27. Of course, if the multiple is about 10. If they don't grow their earnings more in the future, they might be stable, about 18 billion. Now, if Intel, as I said, they succeed to rebound their earnings, to have a nice growth rate, about 4% or 3% a year, then the fair value may be around $40 per share, or the market cap to be around 173 billion for a 10% annual return. So the current level, if you do decide to invest in this company, your return might be about, let's see, 12% a year at the current level. So if Intel succeeds to turn its business around, to make more than 18 billion in earnings in the next 5 to 10 years, then you can have 12% return on your investment. That can happen. But of course, you also have to be realistic. Maybe this company won't grow that much, and the fair value may be around $42 for a 10% annual return. This is just a valuation based on the analyst estimates, what the market expects. And you don't have to trust the market, the analysts. You have to make your own assumptions, your own estimates, and see if this business, Intel, can really make more than 18 billion in earnings by 2028. Because if they don't achieve those numbers, then the stock price won't do too much. It will be flat, maybe around $46, $40, or decline even more, back to $40. So if you want to invest in this company, you have to be very careful. What price you pay, how much are you willing to wait for the rebound in the stock price, and of course the return you want from this investment. You can't expect a lot from Intel to be like Nvidia, to have a return like this, over 200% in just 1 year. You can't expect that. You only can expect a double, maybe a double in the next 5 to 10 years. That may happen if they succeed with their manufacturing capabilities, and they also succeed to improve their segments. Data centers, develop better chips for network, not only for data centers, for client computing, and Mobileye. Mobileye was expecting to have a huge growth rate because, as you know, there is a huge need for autonomous driving. But as you can see, the growth rate wasn't that high, only 11%. You should have seen something like this, over 100%, as it is for Intel Foundry Services. So to sum up, if you do want to invest in Intel, be aware that your return may not be that great in the future. And you have to be aware what price you pay for this company. You might make a nice return in the short term if you buy at the right time, a double, you can have a double if the price gets below $40 per share, then you can make a profit, as it happened in 2020 when it was $25. You could have made a double in just 1 year. That's why you have to focus, always you have to focus on the risk first. As you can see, the best scenario, the fair value is about $27. If you can buy below this price, you may be able to make a nice profit, as it happened in the past. But if you buy when the stock price is higher, then your return won't be that great. That's why you have to put in balance the risk and the reward, and see if you like this kind of business and the return you get. So that's it for this video, and if you have other questions, let me know in the comments.